Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, as we were talking about before the break, right? I was sharing with you how the S&P 500 outperforms 96% of equity mutual funds out there. If you blended, in fact, the S&P 500 index and the Barclays Aggregate Bond Index together, and you did the same thing as far as a 50-50 portfolio that the average investor would have, you will see again that they outperform sometimes by double. Okay, over what the average investor is getting. Sometimes actually it's even more than that. Now, just to illustrate, I've shown you these different graphs to show you how this works. Here's one more that helps now. This one is going to be this hypothetical is based on the work of Dr. Fama with those asset categories and back tested, using computer modeling to show what they would have done, what the model portfolios would have done over that period. So you can see, in fact, that the average mutual fund, that's that bottom number, 100,000 invested back in 1972. So again, over the last 40 years, would have grown to about $1.6 million. That's the average of all mutual funds, stock funds, bond funds, everything together, which is typically what the average investor is going to do. Now, if we take a look at an income and growth portfolio, the next one up, that one's got about 25% in stocks, but we want to measure it against the next one up, 6,600,000. That's how much a moderate portfolio, okay, with the back, that's the return there. All right, that's the 50-50 mix, which would be more comparable to the average investor. So if I have, again, we talked about the S&P, but think of that. This fund over the same period outperformed. Remember, the S&P would have grown to about $6 million over the same period, but with a lot more volatility. Here we get the $6 million with less volatility, and again, that is like almost 4 times what the average investor did over the same period. All right, so that's that strategy. That's the importance of asset allocation, diversification in your portfolio. That's using the Nobel Prize-winning research that we have available to us to develop portfolios. These are the portfolios that I utilize in my practice where I have my own IRA money. But there are other things, too, that we use that people like as much and some like even more. All right? So one of those, and one thing before I do that, again, if you want to find out more about this, for the first 10 callers to my office, you can get a free retirement income analysis, which will include an investment analysis. We're going to show you the best ways to, take a look at your current investment portfolio and show it compared to how you would have done compared to the S&P, how you would have done compared to the model portfolios, side-by-side comparisons. I'll print out reports and show you on your current holdings, your mutual funds, your bond funds, what's in them. Okay, in your stock funds, what's in them? Is there a lot of overlap? Are you heavily weighted in one category as opposed to having a more diversified strategy? All of that is a part of it, in addition to showing you best ways to get the most money out of Social Security, ways to reduce your taxes, ways to minimize risk in your life, okay? And most importantly, I'll also show you how to determine what the needed rate of return is on your own growth, on your savings, on your investments, on your retirement accounts, to make sure you're able to attain and maintain your standard of living and quality of life. All of that in that retirement income analysis for the first 10 callers, 615-376-5325, and I will include my free book, 7 Steps to Financial Freedom in Retirement. And Chapter 5 gets into how the smart money invests, which is some of the stuff I'm covering with you today. All right, now, strategy 2. Okay, you ready? This one is something you may not have heard of before, all right? It's called the J.P. Morgan Mosaic Index. Now, what I'm going to show you is the way this works. So the benefit of a broadly diversified approach. Now, I showed you a portfolio in the market with its ups and downs, less ups and downs, but ups and downs nonetheless, that has 19 distinct asset categories spread over 46 countries, 12,000 different stocks involved. This is a little different strategy. It has 12 different asset classes. All right, here again, the diversified asset select strategy provides opportunities for growth through both traditional and alternative asset classes. Its index diversification is a little different. 3 essential elements: global opportunity, leveraging 3 of the world's most established markets, multiple asset classes across across both equities, fixed incomes, right, bonds, as well as commodities, non-correlated asset classes, including commodities such as precious metals and energy, provided additional growth opportunities beyond traditional equity and fixed income. So they're taking a little different approach here, but yet there are similarities, and they've tweaked it a little bit. A lot of people right now are saying, wow, should I invest in gold? Should I invest in precious metals? This may be a way, well, just with both portfolios I'm showing you, are a way that you can get that type of protection within your portfolio without having to go out and buy something that may not hold its value over the long term. All right, the next slide is going to show you then harnessing the positive momentum. What they next do is every month they take the out of those 12 asset categories, they choose the top 6, exhibiting the greatest positive returns and strategically allocate those. So they look over the last 6 months every month. They look over the past 6 months' performance. They then select the top 6. They then weight those according to the best performer, the next best, and so on. And then that becomes that then is the portfolio for that month. Then the next month they do the same thing. It's all done with computer algorithms. It's all set up on automatic. It runs with it. Now we're thinking, does it work? Now there's 2 reasons I like this. One of them is shown in the next slide. Let's compare it to the S&P over the last 16 years, right? Now keep in mind, we're throwing in 1999. Up to this point, I've been talking mainly about 2000 through 2015, and I did that on purpose because that was one of the, to me, that shows the 2 bear markets, and I purposely left out the 80s and 90s, 2 of the biggest decades in the market, because I want to be more conservative in my approach. However, this is put out by Nationwide Insurance, and one of the things that they show with the J.P. Morgan Mosaic, if you look at the chart and look at how it did. Now keep in mind that the S&P 500 in 1999 had almost a 20% return that year. And that's included in this, and yet still, when we look at that through the last 16 years, the average return was only 3.28% over that 16-year period. Whereas the Mosaic has generated steady positive growth, less volatility. This is through a variety of market environments. This has to do with the monthly allocation, of course. This shows the actual and back-tested performance in which the index experienced a 69% higher compound annual return than the S&P 500 with 79% less volatility. And what did we say again, right? The S&P outperforms 96% of equity mutual funds. Here's an index that outperformed the S&P, just as we showed you with that other strategy, utilizing the asset allocation in the model portfolios. Now here's the next slide. One of the things we're seeing now, it breaks it down into each year. What I showed on the first one was the growth. Now we see the actual returns for each year. And you see on the J.P. Morgan Mosaic, the farthest right, you see even during 2000-2002, when the market dropped, again, the S&P over that period over 40%, and yet on the J.P. Morgan it made money. Smoothing out volatility and giving you better returns, that's what it's about. All right, we're going to take a break. When we come back, I'm going to kind of wrap this up, show you how you can find out more about these, information that we can provide you, okay? So join us here, and I'll show you how you can, in fact, take advantage of those 2 strategies and improve your returns as well. Join us here. We'll be right back on the Retirement Report.